Welcome to Mid-State Money Talk. My name is Cynthia DeFazio, joined today by Joe Dietrich and Kevin Dietrich of First Choice Financial Services. And to our viewers at home, we're going to talk about the elephant in the room because we have to. We're going to talk about taxes. A lot of people are in the assumption, if you will, that when taxes hit in your retirement years, you're going to pay less in taxes. Is that true? We're going to do a deep dive into what someone's tax implications could be in retirement on today's show. So you don't want to miss this. We know we all have to pay taxes. Let's talk about how much and how we do it. Kevin, how are you today?
I'm great. How are you?
I am fantastic.
That's a beautiful dress. I like that color.
Thank you.
Yeah.
Green is my favorite color because it's spring, it's happy, it's new life. So thank you so much. Thank you. Joe, how are you?
I'm doing wonderful. It's good to see you.
It's good to see you too. Yeah. And I know that you're so passionate about the overall retirement plan. You really take a holistic overview of someone's needs, their wants, their goals in retirement, and that's how you design a plan. And a lot of times when you're talking to folks, you're talking about taxes. So let's talk about that for today's show if we could. Kevin, before we dive in, I think a lot of people are confused with the difference between tax planning and tax preparation. Can you do a deep dive into both?
Yeah, sure. Tax preparation is basically just doing the taxes. So that's what your CPA does or what your tax professional does, H&R Block or whatever that might be. Tax planning is a proactive, forward-looking strategy, anticipating taxation, works to minimize your tax bills.
Okay, all right. Yep. And Joe, why is it important to really do more of the tax planning piece when it comes to someone's retirement plan versus just taking everything into an accountant, if you will?
Yeah, from the day one when we meet somebody new, we talk a lot about being proactive. And tax planning is being proactive. We're being forward-looking, not only what we're going to pay from last year's income, but looking this year, 5 years, 10 years down the road and making some preparations to really maximize what our income is coming in and minimizing what it is that we're going to be owing in taxes. So, you know, that's the difference. That's the gap between could be significant as you throughout your entire retirement years. You know, a few degrees here or there, a little bit more net income every year going to add up in the long run.
And I think that's interesting when you say that because, Kevin, there's an understanding that people have that once they retire, their taxes are going to go down. Why do you think people feel that way?
I think people feel that way because they're going to make less money, you know, but that's not necessarily true. I've had clients come in, prospects come in, and they have good Social Security checks, they have nice pensions, and they're actually making more money in retirement than they are when they were working. So,
yes.
So it doesn't necessarily going to come down. But also, we're going to talk about this later, but RMDs, required minimum distributions, when you hit a certain age, you have to start taking money out of your IRAs. And so when that comes into your pocketbook, so to speak, it's taxable. And so that might bump you up another tax bracket. So taxes really is one of the top two most highly cost in retirement.
Okay, something that's very important to understand and to know going forward.
Absolutely.
So, Joe, there are 3 different types of accounts that people typically have. There's 3 different types of taxation. So let's go through each one and break those down if we could. The first one would be taxable accounts. So when you're thinking of taxable accounts, what do these include?
Correct, yeah. So these are the accounts that you're going to be responsible for taxes on every year. And there are going to be some things like your checking or savings account, maybe bank CDs, money market accounts, and then the big ones, your stocks, bonds, your mutual funds that are in a brokerage account that aren't your retirement funds. These are going to be things that you're responsible for every year, so we call those taxable. And they're going to be taxable regardless of whether those interest and dividends are either pulled out and you actually spend them, or they just remain in the account and are reinvested. So you may still be responsible for those in differing degrees. That might be taxable as income, it might be taxable under a capital gains, but you will be responsible for them every year.
Okay, would CDs also fall into that category
as
well? Okay, so stocks, bonds, mutual funds?
Yes.
And what about money market funds?
Money market funds.
Wow, so all of these things we have to take into account.
That's right.
Okay. The next big one are the type of accounts that most Americans have their savings tied up in. These would be tax-deferred accounts. Kevin, can we break that down just a little bit? What are the tax-deferred accounts?
Sure. So I like to make things simple, right? And simple is better. So when the IRS looks at money for the tax purposes, they look at is it taxable? They call those non-qualified accounts. That's another term for that.
Okay.
And then IRAs, well, that's a qualified account. So it meets the qualification for tax deferring.
Okay.
So you have IRAs, you have your 403Bs, your 401Ks, your TSPs. And so those are all qualified accounts or tax deferred accounts. You're deferring the tax to when you pull the money out.
Okay.
So anything that's already been taxed or pre-tax is a taxable account, or a non-qualified account, same difference.
Okay. Would annuities fall into that category as well?
Well, annuity is an investment in vehicle.
Okay.
So a stock is an investment vehicle, mutual fund, bonds, CDs are investment vehicle. You can have IRA money in a CD.
Okay.
You can have non-IRA money, which are non-qualified money, in a CD. Same thing with annuity.
And you can have obviously an annuity that's an IRA, but you can have an annuity that's not an IRA, a taxable account, and you're going to get that tax deferral benefit there. So it does end up falling into the same type of tax treatment as an IRA or a 401k.
And that's actually a good point, because that's actually where the tax planning comes into play. So in a higher net worth person, if they have money, they could put into an annuity, and then they're not paying capital gains every year on it. It's growing tax deferred.
Wow.
Okay, so you're not taking that income while you're working and making $100,000 a year on your regular job, and then taking maybe $20,000, $30,000, $40,000 of capital gains tax every year. That's huge.
That is.
And so that's where the planning comes into play, the tax planning, not the tax preparation, but the tax planning.
True tax planning.
Yep.
Absolutely. And then, Joe, this next one, the third type of account, which I think is most interesting, would be the tax-free accounts. What are those?
Yeah, doesn't that sound great, right?
Yes.
The star of the show.
Tax-free is always good.
Yeah, so tax-free accounts, we're talking about the Roth accounts.
Yes.
So your Roth 401k or your Roth IRA. We're also talking about life insurance that has properly managed cash account in it as well. And so, being able to have all three types of accounts is super important when you're trying to really be strategic in your income planning and your tax planning.
Okay. And what about municipal bonds and life insurance? Do they fall into that as well?
Yes, right. The life insurance, I said, with the cash value in there, and then your municipal bonds are going to be coming in tax-free as well.
Okay.
Yep.
Again, those are just vehicles.
Yes.
Right? So a Roth is just a tax qualification on a particular investment that you have.
Yep.
Okay.
We like to say that each investment has a purpose. It's meant to do something, right? And so you want to make sure that your money is placed into the account, into the tax qualifications that are going to best suit you now and in the future.
Absolutely. So what it comes down to truly, gentlemen, is really proper planning. You have to have proper planning.
Yeah, a lot of folks come in their office and say, well, can I have a Roth in an annuity? You mentioned that earlier about an IRA. Of course you can. Can I have a Roth in my 401k? Of course you can. So a lot of times 401ks will have IRA, traditional IRA, or Roth inside the same 401k account.
Yep.
So it's just a different tax bucket or tax qualification.
Yeah, it's funny because we do workshops often and live events. So we're interacting with people and for the first time. And a lot of times we'll get this question as to what would be a good Roth, or what kind of return should I expect in a Roth account, right?
Yes.
Well, it depends, because Roth is really just that tax qualification. We can have that invested in many different areas. So, it's just from day one, it's a heart of ours to make sure that we're educating and really taking a look at planning for the future.
Absolutely.
People don't know what they don't know.
Exactly.
So it's really good for us to have these particular episodes, so our viewers at home can just really see what we can do for them and get some education, because they don't know what they don't know. And that's not fair.
Power. Yes, absolutely, Kevin. I couldn't agree more. We're going to take a very short commercial break. To our viewers at home, there's a number to call on your screen, 888-959-2743. If you're in the viewing audience today and you're listening to the show and watching the show and you're asking yourself, do I have a retirement plan? Do I have a tax plan for my retirement years? If the answer is no, pick up the phone and call in today, 888-959-2743. What you're being offered is a complimentary consultation. Come into the office of First Choice Financial Services and discover the difference. You're going to really be listened to. You're going to be really heard. The gentleman will understand what your goals are and design a plan that will suit your needs for every aspect of your retirement. No obligation, totally free. The number is 888-959-2743, or grab your smartphone, click on that QR code at the bottom corner of your screen, and you can claim your spot accordingly. We're going to take a very short commercial break. Don't go anywhere. We're talking all about taxes in retirement and how to potentially lower your tax burden, if you will. Stay tuned.
The work never seems to end until the day it finally does. After nearly a lifetime on the job, you should be rewarded for all the time you spent working. Whether that's crossing off items on your bucket list, learning a new passion, or rekindling the love of an old one. After all, life isn't over when you stop working. It's the start of an all-new chapter. The one where you're the writer and you get to choose how your story will go. A way to achieve that is by having a clear financial plan to sustain your golden years. The biggest fear most retirees have is if they'll have enough money to maintain the lifestyle they've always enjoyed. Having a plan to help protect you against the curveballs life often throws will help to maintain your lifestyle. Call today to get your free written financial plan so you may live every day to the fullest and enjoy the retirement of your dreams.
Welcome back to Mid-State Money Talk. My name is Cynthia DeFazio, joined today by Joe Dietrich and Kevin Dietrich of First Choice Financial Services. And we're talking all about tax planning for your retirement years. We uncovered the three types of accounts that people have. You have taxable, tax-deferred, and tax-free. When it comes to allocating your assets for taxation and to make the most efficient decisions for how to withdraw your income, we really have to do a deep dive into what those tax implications should be and could be. So I should ask you, Kevin, overall, we're in a low tax environment, but let's explain to the viewers at home, where are we in our tax history, if you will?
Yeah, we're actually in pretty good shape. Tax laws tax laws and tax rates are not fixed.
Okay.
And this is really the currently we're at historic lows with our taxes. This is why you may want to consider choosing investments that accounts that offer tax advantages can reduce your future tax bill.
Okay. So overall, right now, you would say taxes are on sale. This is the time,
Yes,
to act. Absolutely.
Yep.
Yeah, currently, like you said, we're in record low tax bracket, and that's not going to last, most likely.
Most likely.
It expires at the end of 2025. And so unless Congress does something different, those are going to expire and rates will be going back up.
Well, when you think about it, Joe, the majority of people have all of their funds sometimes in those tax-deferred accounts. What's going to happen when it becomes time to take those withdrawals? Aren't they known as RMDs?
That's correct. That's correct.
Okay.
It's often people come in and we would sit down and start looking at and they've invested heavily and saved really well in those tax-deferred buckets. But at some point, like you said, they're going to be responsible for RMDs. At age 73, they're going to be required to take that money out, whether they need it or not. That may be part of their income plan and that what they need to live. But sometimes it's not. We have many clients where they're not touching those funds at that time or not planning to, and all of a sudden they're forced to take that out every year. Now that's got wide sweeping implications, and that could really impact taxes in other areas other than what you think.
And I think it's important to talk about the fact when you meet with someone for the first time, they may come in and say, I have $1 million in my 401k. But that's not true. There is a partner. Let's talk about who that partner is,
that
Kevin.
partner is the IRS.
Okay.
Yeah. And so, I mean, if you're in a 25% tax bracket, 25% of that money is not yours.
Wow.
So it's really important to get that out in a lower tax rate, the best you can, and maybe put it into a Roth.
Okay.
Okay? So that's really key planning.
All right.
Yeah.
And what exactly is a Roth, in case someone is watching for the first time? Can we talk about what that vehicle is?
Yeah, so that Roth, well, the vehicle is whatever investment vehicle you want it to be in or what's best suitable for you. A Roth just is a tax-free account.
Okay.
And so we can just do, you can open a Roth and put contributions into it, or you can actually convert existing IRA money to a Roth.
Okay.
And those are called Roth conversions.
Okay, thank you, Kevin.
Yeah.
Joe, if you don't implement something like the Roth, what are some of the tax implications when people start taking money out of these accounts?
Absolutely. So you may be sitting in a tax bracket that you're comfortable with, and now all of a sudden you're forced to take this additional income. Well, that puts you in a new tax bracket, but that's just the beginning. So there's also implications on the amount of your Social Security that's being taxed. That's not a static number either. So that ranges depending upon what your income is. So you could be paying more Social Security tax. You could also be paying more for your Medicare Part B and Part D because you've now met certain thresholds that you're having additional premium surcharge added to that every month. That could be 40%, that could be 100% more, depending on those thresholds.
Kevin, I should ask you a question. When people are going through their retirement planning process, how often are taxes overlooked until they come into the office for the first time?
A lot.
Okay.
I don't want to put a percentage on it, but people don't think about it. A lot of folks, we get this comment all the time that I never thought about taxes. We do a workshop every month, and we focus on Social Security and taxes. And I do the tax portion a lot of times, and Joe does the Social Security, but we can do both. And I talk about that taxes is probably one of the top 2 biggest costly things you will face in retirement.
Yes.
And so long-term care and, of course, then taxes. And that just blows people's mind because they don't understand, they don't realize that. You mentioned earlier, the question was, a lot of folks think that taxes are going to go down in retirement. And a lot of times they do come down a little bit. You might go from a 20% tax bracket down to 15, or a 15% tax rate down to 13 or 12% tax rate. They might, but then it might jump back up to a 15 or 8 or 20% tax rate based on what the government does.
Yep.
It's been also based on RMDs and all other factors.
Okay.
Yeah, when we talk about our tax brackets, but we also talk a lot about an effective tax rate, and that's really just the average of all of the tax that you're paying, and that could really be impacted. You may have your tiered tax brackets, but your overall effective tax rate can be, significantly impacted by RMDs.
And what happens with Social Security, because that's taxed as well? Can that sometimes increase tax on Social Security?
Yeah, Social Security can be taxed.
Okay.
That's called provisional income. And so when you have Social Security and you have other income to combine, they do a factor and do a formula to see how much of your Social Security is taxable. And I'm not going to throw out some numbers out there, but if you look up provisional income on Google or come in and see us, we'll talk about that. We talk about that at the workshop every month. So that's part of the education. But yeah, Social Security can be subject to tax.
Okay, perfect.
And that would be taxed at whatever. Sorry, that would be taxed at whatever rate you're currently paying income tax on.
Okay. And Joe, you mentioned the workshops. Let's talk about where people can find you.
Yes, you can find us at our website at firstchoicefinancialservices.com. Go to the website, look for our live events, and we'll see a number of events for our workshops coming up. And also, we have. If you are a client, you'll also be able to look at your client events that are coming up and look at those as well.
I love that. I love that. Well, gentlemen, we're going to take our second commercial break. But when we come back, we're going to talk about the tax control toolbox. I can't wait. To the viewers at home, there's a number to call on your screen, and that number is 888-959-2743. If you're in the viewing audience today and you're hearing a lot of this information for the very first time, this is the perfect opportunity for you to call in and take advantage of the complimentary consultation. The number is 888-959-2743. You deserve to have a well-constructed, holistic retirement plan. You've worked your entire life to get to the retirement years. You deserve to have peace of mind. No obligation, completely complimentary. That number again is 888-959-2743. If you don't have a pen handy, just grab your smartphone. You can click on the QR code at the bottom corner of your screen. That will take you right to the landing page for First Choice Financial Services. We're going to take a very short commercial break, but don't go anywhere. We're going to talk about the tax control toolbox. What is it? Stay tuned.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just a downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
Welcome back to Midstate Money Talk. My name is Cynthia DeFazio, joined today by Joe Dietrich and Kevin Dietrich of First Choice Financial Services, and we're talking all about taxes in your retirement years. What do they look like, and how do you help reduce the burden, if you will? So we're going to talk a little bit about the tax toolbox, and I know that you implement a lot of strategies to help people pay what is known as their fair share, but not too much more. So we're going to talk about that. So let's talk about navigating through tax bills. What do you do? What's the first tool in the toolbox, Kevin?
Well, making sure that your accounts are properly structured, that they're in the right account type, the tax type. So you make sure you have some tax-free money, some tax-deferred accounts, and some taxable accounts, and make sure they're in the right investment vehicles. We talked about investment vehicles before. Are they in the market? Are they in an annuity? Are they in a fixed account? What are they in? And so make sure they're properly structured to best fit your needs.
Okay, all right. And what about withdrawal from multiple accounts to build your retirement income based on your expected tax bill? Joe?
Absolutely. Kevin is building that foundation. So now that we have all of those accounts in place, now we can be very strategic in how much we may take from each of those accounts to really control, to the degree we can, the tax brackets that we're comfortable with, that we can minimize those tax year over year. And we don't want to be short-sighted. We don't want to say, well, I'm going to zero tax this year and then next year I'm going to be really hit. We want to make sure that that's sustainable year over year. It's not only about today, but 5-10 years down the road.
Absolutely.
Okay.
That's part of the planning.
Absolutely. And we alluded a little bit to Roth conversions, and you do this for your clients a lot. Can we explain in further detail what is a Roth conversion, and most importantly, how is it done?
Yeah, Roth conversions are very, very important as you approach retirement and in retirement years. So there's two ways to fund a Roth, if you will. That's to contribute, and the government limits how much you can contribute to that each year. Just like you can only contribute certain money to an IRA. Okay, but you also can take existing IRA money and convert it to Roth. Now you pay the tax on that, whatever tax bracket that you're in. And so we have to do that systematically over a number of years. Whatever works for you individually each year, as far as to keep you in the same tax bracket, or maybe even a lower tax bracket, to replace that money that's IRA money and convert it to Roth.
Okay, all right.
Yeah, so
Excellent.
For example, I just met with a couple a few weeks ago, and the gentleman just retired. He's living life. He's enjoying it. His wife's going to retire next year, and so here we are now. We're in this zone where they've got all their income's gone, and they're in a really low tax bracket. Well, this might be an opportune time to look at those Roth conversions and really strategically decide how much is appropriate to start converting from that large IRA or that large 401k over to those Roth conversions at a really effective low tax rate. And we can do that strategically over a number of years to really minimize the amount of taxes that we're paying. We don't want to just throw a dart at a dartboard and say, let's convert all of it, and that's going to really put us in trouble. So it's important to sit down with somebody who has experience doing this in a very strategic way. So a lot of times, we just want to see this great idea and we want to implement it right away. Well, let's just take a second and sit down and make sure that it fits properly into your planning.
Yes, because
Yeah.
let's talk about, Kevin, please, I didn't want to interrupt you. Go
that's
ahead.
what we talk about actually at our live events, our workshops. We touch on Social Security and all the aspects of that. We touch on tax planning, and that's a big part of our tax planning portion of the workshop is that Roth conversion. We actually show them an example how to do that systematically over a number of years. And so that's all part of the planning that you get at First Choice Financial.
I love that. And obviously, if you're looking at converting both, you talked about the pros and the cons. Should we spend a little bit of time talking about what the pros and cons are before we close?
Absolutely. Yeah.
That would be fantastic.
Okay, so the pros obviously is we're rebalancing from our tax deferred account to a tax-free account, right? So our tax deferred account, we didn't pay any taxes on the money going in. So that's seed, say the seed money, right?
Okay.
But when we take the money out, we have to pay taxes on not only the seed, but the harvest or the growth, okay? And as we transition that effectively, now we've got it into an account where we've already paid the taxes on it, so there's no tax due on the seed or the growth. That grows tax-free. And there's obviously some stipulations that has to be open for 5 years. You have to be 59 and a half, but that's tax-free income to you and your heirs, and what's better than that?
Nothing's better than that.
Exactly.
That's fantastic.
And you know what? Another thing is that the Roth money is not part of the required minimum distribution.
Ah.
So that's only on IRA money. And so if you can convert a lot of your IRAs over a period of time to Roth, you're saving on having to take it out.
Wow.
Because everyone likes to be told what to do by the government, right?
Nobody
No.
knows.
So they say you have to start taking money out at 73 or 75 years of age based on your date of birth. But why do you have to take it all out? Because they told you to, right?
Exactly.
Because you put it into an IRA, tax deferred for a number of years, and that's part of the rule that they had. So let's convert some of the money over to Roth as much as you can. And even while you start taking RMDs, you can still convert money to Roth. Basically, to the day you die, if you need to, you can convert money to a Roth.
As long as it makes sense. And there's times
That's
where,
right.
where perhaps it doesn't make sense. It really needs to fit into your plan. You may be into a position where your tax bracket is kind of flipped. Now, all of a sudden, you are in a lower tax bracket. Maybe that doesn't make sense for you. But we're able to, through our planning process, take a look exactly where you are and when it makes sense and when it doesn't.
And how much?
And how much?
Yeah.
So, gentlemen, really what it comes down to is having a proper plan in place for the retirement years.
Yep.
Kevin, thank you for another amazing episode.
Thank you.
And Joe, thank
Been a
you as
pleasure.
well. To the viewers at home, there is a difference when you're choosing a financial advisor. As you can see, if you decide to work with First Choice Financial Services, you're going to be listened to. Call that number today for your retirement plan. It's complimentary, 888-959-2743, or grab your smartphone, click on that QR code at the bottom corner of your screen. That will take you right to the landing page, and you can claim your time accordingly. Be safe, be happy, and be blessed. We'll see you back 1 week from today. Take care.